Hey there, this is Pat Ennis of Ennis Legacy Partners. Welcome to the Exit Readiness Podcast. I'm here with my co-host, Walter Dial, CPA and tax partner at GRF CPAs and Advisors in Bethesda, Maryland. Our mission here on the podcast is to provide you, the business owner, with subject matter expertise on topics pertaining to building transferable or sellable business value, and then for planning your eventual exit from the business. We want to help you build a business that's transferable and then exit successfully on your own terms and conditions. Walter, we know that building a sellable or transferable business not only helps an owner enjoy more freedom and control in the business today, or enjoy life in the business today, which we want to see them do, but it is also foundational for an owner to eventually realize a successful exit from the business. We know this 100% sure. They're going to exit one way or another eventually from the business. And of course, we want them to be in control of that exit. And building a transferable business or sellable business is absolutely foundational to eventually realizing a successful exit from the business. And it doesn't matter if they sell to a third party, sell to key employees or insiders, or an ESOP, or transfer the business to children or family. You still need to build that sellable, strong, sellable, transferable business.
Yeah, that's right, Pat. And there's lots of different features of a sellable business, and we talk about a lot of them during these podcasts. But foundationally, and I think the one most people understand, is you have to have a company that has very strong financial performance. The stronger the financial performance, the more sellable the business is, and obviously the higher price you're going to get. And one of the strategies that we often use when we're working with business owners to help increase the value of their business is something called incentive compensation plan. So that's a great strategy that an owner can employ to ensure strong financial performance for their company. And I think our listeners are probably familiar with a lot of different incentive comp plans. I mean, kind of the basics, like just a cash bonus plan, for instance. But then you get into the more complicated or exotic type structures like restricted stock or stock options. But I think most of our listeners are probably familiar with those. But today we're going to talk about one that most listeners are probably not as familiar with, if they've heard of it at all. And that's phantom stock as an employee incentive. So that's our topic today, using phantom stock as an employee incentive plan. And we're really excited to have with us today Paolo Pasicolan of the law firm Miles and Stockbridge. Paolo has law expertise in executive comp, employee benefits, tax, and ERISA litigation. His clients have included large and small companies, private and public companies, and foreign and domestic companies. So he's pretty much covered it all, including partnerships, nonprofits, governmental entities, churches, planned fiduciaries, and individuals. I'm not sure there's any existing entity, Paolo, that you have not worked with, but maybe there is one out there. I'm not sure. So Pat and I are confident that Paolo is the perfect guest to have on to discuss phantom stock plans with us. So Paolo, welcome to the podcast. Great to have you with us.
Thank you for having me.
Yeah. Hey, Paolo. Thanks for joining us today. First off, how bad did Walter butcher your last name?
Good question.
No, it's close enough. It's Pasicolan.
Yeah, I tried to make it too complicated. When you have Dial spelled Deyhle, you tend to look for the complicated way to say a name.
Yeah, and to this day, I still at times switch the Y and the H in there after 20 years. So Paolo, again, thanks for joining us today. We're excited about the conversation because this does often, we bring up incentive planning all the time because of what Walter was pointing out. And, we want to get into how an owner should decide to install a phantom stock plan, when and how to use it, instead of maybe other plans. But first, let's have you describe what it actually is. for those listeners who are not familiar with what a phantom stock plan is.
Sure. So let me start by saying the tricky part about phantom stock is there's no legal or tax definition of what phantom stock is. If you look at the Internal Revenue Code, you can find what a stock option is. You can find what restricted stock is, but there's no definition of phantom stock. And what's worse is phantom stock comes with aliases. There are other names for phantom stock. They're sometimes called restricted stock units, synthetic equity, shadow stock, simulated stock, all of these, sinister sounding awards. So they can be very intimidating, right? Like phantom stock sounds like a superhero from the 70s or something. Right. And then to make it worse, there's kind of no commonly accepted term. Even though there's no definition in the tax code, usually there's like a common understanding by experts or lawyers or accountants, but there's not even that. And there's no commonly used design. So that's what kind of makes it difficult. But when you really look down into it, it's really not that complicated. It shouldn't be daunting for owners, employers that want to try to understand it. You just get over the problem with the names. But phantom equity is basically a simple concept. It's a promise to give someone some or all rights of an equity holder without actually giving that person equity. That's one definition of phantom stock. And it's probably easier to understand phantom stock if I kind of give you examples of phantom stock, examples of design. So one common design of phantom stock, usually called restricted stock units, is it's a contractual promise to issue stock in the future. So let's say you're an employer, you want to keep, a key executive. You say, if you stay with me for 5 years, in year 5, I will issue you 100 shares of stock. Let's enter into a contract. That's a restricted stock unit agreement. Day 1, he's not a stockholder. He only becomes a stockholder if after year 5, he's still there and you issue him stock. Another design of phantom stock, and usually when you say phantom stock, this is what most people mean, is...
Hey, one follow-up question to that first point you made there, Paolo. In the future, when that stock is awarded, the actual stock, how's it valued? Is it valued at the time, the value at the time it's granted, or at another time? How would it be valued?
So that's a good question. So it's valued at the time the shares are issued, and that's going to be the tax event. And we can discuss taxes in more detail later. But just to return to the other example of a phantom stock, a common design for phantom stock, is it's a complicated sale bonus, essentially. It's a fancy term for a sale bonus. So you have a phantom stock that says, okay, I'm going to give you 100 shares of phantom stock. If you are here at the time of an exit event, sale of the company, for example, I will pay you the cash equivalent of the sale proceeds to someone who theoretically owns 100 shares of actual stock. You're not going to be a stockholder. You don't have any dividend rights. You don't have any voting rights. But when we share the company, when I sell the company, I'm going to pay you an amount and treat you like you're a holder of 100 shares. That's another design of a phantom stock. And a variation on that theme is adding a hurdle to it. If I sell the company for more than $5 million, you will get 1% of the sale proceeds above $5 million. And that's a kind of common design for granting an executive who joined the company when the company's value was already $5 million. So the idea is you're incenting that executive to grow the value of the company over the value that he came in at. So it's kind of like an appreciation right. So
okay, hey Paolo.
Mhm.
So one of the things that Walter and I will encourage a small business owner to do if they're considering sale to a third party is any key employees that would be critical for the transition, make arrangements to compensate them to remain during the transition. Because if I'm buying your company, and I know that you've got Sarah, Tom, and Jane are key employees, and if I buy your company and they leave the next day, I'm in big trouble. So my risk goes up, and so the amount of money I want to pay you goes down. So the scenario that you just mentioned, using phantom stock as an incentive in the way you just described, could the payout be scheduled to include at sale, but then over time after sale, in order to get those key employees to remain on board for a period of time?
Yes, that's one of the great things about phantom stock is it's very flexible. You can design it basically as you like, and there are some, but not many, constraints on the tax side. So you can make a phantom stock vest, so to speak, at the time of the sale. Simple sale bonus. If you stay with the company at the time of the sale, I'll pay you just before closing or shortly thereafter. Or you could say, if you stay with the company for 1 year after a sale of the company, you will be paid X, Y, or Z. And you can pay that in shares, cash, combination of cash or shares. There's a lot of flexibility when it comes to phantom stock.
So Paolo, let me ask you a question, because a lot of our clients, they're small businesses. Oftentimes there's even just a sole owner. And I'm sure Pat has had this call, as I certainly have, where the owner calls you and he's like, hey, I've got this, thinking of hiring this guy and I'd like to bring him on as an owner. And right off the bat, I just get very nervous about that, because they're bringing somebody in who they've never, they think they know them pretty well, but you really don't know anybody from the context of being a part owner of your business until you've worked with them, and you actually, you just get to know them a whole lot better once they're with you. So I really try to encourage people in that situation, if they really feel they have to do something right off the bat, to do some type of phantom equity, because it just scares me that they're going to add a minority owner, and I think most business owners don't understand the implications of adding another real owner. Is that kind of your feeling, or how do you feel about it?
I agree with that. I think most owners don't realize kind of the corporate rights and the legal minority rights that a shareholder has, the kind of right to information, the right to vote, and all of those things. And maybe, some owners aren't thinking far enough into the future, and usually, and maybe I'm biased because I'm an attorney and I only get called when things go wrong.
Right.
When a relationship sours and you have a minority shareholder, sometimes it's difficult to get rid of them. If you don't have any kind of repurchase rights or call rights for the shares, getting rid of them could be a problem. And if you grant stock, if you grant stock, or you have even award a restricted stock, that means that person is a shareholder on day one. On the date that you sign the agreement, they're a shareholder with certain state legal rights with regard to the company.
Yeah. I think one thing that Pat is really, really good at, he's done this for a number of clients, is, trying to have this discussion with the business owner that just because someone is a quote unquote key employee or even a good employee, they're not necessarily going to be a great shareholder or owner. I mean, it's a really a different world when you become the owner of a company, and some people are suited to it and some aren't. So I just, I think it's really important that anyone making a decision to add an owner really consults with the professionals and just really gives it a lot of thought, because it's a huge decision.
Yeah, and let me add something on the flip side from the employee perspective. I've seen some problems where an owner thinks this is a good idea. I'm going to grant my key employee equity in the company. But if the company is a partnership or taxed as a partnership, they're not thinking, you know what, I'm complicating the tax life of my employee.
Right.
They're now no longer a W-2 employee. Now they're a partner in a partnership. And that, as you probably know,
right.
that your annual tax return becomes far more complicated.
Sure.
You are no longer eligible for certain tax-free benefits if you are a partner in a partnership. And so sometimes an owner will do that, have the tax consequences, discover it later when it's time to file the taxes, and it can get very tricky and problematic for the employee. So the employee should understand what they're getting into if they're becoming a partner in a partnership.
That's a great point.
Yeah, not only that, and that's a phenomenal point. One that is almost never, well, you never want to say never, but it's seldom acknowledged and considered until someone brings it up, like you or us. And then the other thing in regard to the employees, what we have found is most employees with small businesses, they would rather have cash bonuses, and phantom stock is of course a cash based plan, and so that's another aspect, wouldn't you say, Paolo?
Oh, absolutely. Equity is complicated. When you issue equity, you have to look to see if there are any registration or notice requirements under federal and state law. There are, different tax treatment with different tax awards, and so on and so forth. Whereas if you grant phantom stock that's issuable, payable in cash, you're essentially just setting up a complicated cash bonus structure, which is, from the employee perspective, good in a way because it's easy to understand. They get taxed when they get paid, and it's taxed as wages. There's no disconnect between FICA and income tax and so on and so forth. So it's in a way easier to understand and easier to administer.
Hey, Paolo, do you see these plans as being kind of standalone, or have you seen companies that have a phantom stock plan, they have a stock option plan, they have a cash bonus plan? What do you normally see out there?
That's a great question, because I always get the question of, what's the difference between a plan and an agreement? Do I need a plan? Can I just have an agreement? And they're essentially, a plan and an agreement. There's not really a legal distinction between the two of them. They're both contracts. So I like to think of it as a rule of thumb of, if you anticipate granting fewer than a handful of these awards, fewer than 5 awards, because you only have a few key employees, and you will for the medium and long term, you're only going to have a few key employees. It just makes sense to have an agreement where you have all the terms in the agreement, you sign it. If you want another one, you just mimic that agreement, you change the name of the recipient. But if you're going to grant an award to more than 5 people and have varying kind of vesting schedules and designs and so on and so forth, it makes sense to have a plan and an award agreement where the plan document will have all of the terms that apply to all awards. And then the award agreement will have the specific terms, the number of shares, the amount of cash payable, the timing and all of that that's specific to that individual. And that's kind of the easier way to do it administratively.
I see.
Yeah. So, hey, Paolo, listeners, our audience is small business owners. And whenever they start hearing things like plans and agreements and attorneys talking about such things, or CPAs too,
Hey, wait a minute.
cha-ching, they're thinking cha-ching, cha-ching. So, give them an idea as to what they can expect. Nobody's going to hold you to it, but maybe. But ballpark, what it can cost someone to get a plan and or agreement set up.
It really depends on kind of pre-planning, and this is probably true for all lawyers. It's a good idea for an owner to kind of talk with their advisors and have a sense of what they want to do, right? Have a sense of what their goals are, to incent, when to pay, any vesting schedules, or kind of have all of the major terms set in their mind. Maybe not set, but at least have a game plan.
Uh-huh.
Then consult an attorney or an advisor in terms of setting up the details for a specific award. Then you can retain whoever is drafting the documents to do the drafting. And if you do that, it's not going to be that expensive. The cost comes with, okay, I have an owner has this vague sense of, I want to grant equity or equity-based awards, draft me a stock option. And after we draft a stock option document, we realize, oh, you know what, that's not, the tax consequences of that are not, can you just change that and turn it into a phantom stock?
Mm-hmm.
That's when the costs start accruing. But if you have a good game plan and all you need to do is, draft an agreement or a plan, it shouldn't be, that expensive. And I'm ballparking here between $5,000 and $7,500. $5,000, $7,500.
Yeah, that's helpful. And then what about ongoing maintenance, annual maintenance? Is there, like, for instance, this is a good time to ask about valuation. Phantom stock, there needs to be a valuation of the shares, right? And so you want to talk about that, and is there an annual valuation that's required? Walter's a certified valuation specialist. Like with ESOPs, that's one of the things about ESOPs is you need to have that. Is that true with phantom stock? And is there any other maintenance that an owner would need to be considering and having to plan to pay for?
That's a great question. Comes up a lot. One of the good things about phantom stock is you actually don't need a valuation. If you're granting stock options, for technical reasons that I don't want to get into, I'll just throw out 409A, section 409A of the tax code. For anyone who's familiar with it, they'll know. You want to grant options at no less than fair, with an exercise price at no less than fair market value on the grant date. So you need a valuation for that. If you're granting restricted stock, an employee might want to make what's called an 83B election. To do that, they would need to know the value of the shares that are transferred, even if the shares are subject to kind of forfeiture. You probably want to have a valuation for that too. But for restricted stock, you don't necessarily need to have a valuation, depending on the design. So for example, if you have a restricted stock unit that says, you stay with the company for 5 years and I'll grant you 100 shares in year 5. You don't need a valuation for that, right? When you issue the shares, they get the shares. They don't need to know the value of the shares. I mean, you will need to kind of report that for tax purposes, because you need to include the value of the shares in year 5 in their wages, but you don't necessarily need a full 409A, what's called a 409A valuation, in order to get that accomplished. If you have a reasonable valuation, that's okay for tax purposes. So there isn't necessarily a need for a formal valuation when granting restricted stock.
Okay, and in that, you were using the term restricted stock there more than you were phantom stock, but you were referring to phantom stock.
I'm
right?
sorry, yes, you're right. I meant phantom stock, yes.
Yeah.
Hey,
Yeah,
Paolo,
you mentioned earlier that you can't find the term phantom stock anywhere in the code, in the revenue code, IRS. Does that mean then that there's no requirement to register phantom stock with the government or any kind of governmental approval?
That's a good question. If you're granting equity, stock options, restricted stock, you need to look into whether or not you have to register the shares. There's a federal rule where you can get exempted from federal rules if you stay under certain dollar amounts and thresholds. But you also have to look at state-specific, what's called blue sky laws, where you need to register securities. Some employers don't want to go through that hassle, so they grant phantom stock payable in cash, which is essentially a cash bonus that is not required to be registered because it's not a security. But if you are granting phantom stock that is payable or settlable in securities, then you want to look into registration requirements in various states.
hey, Paolo, I don't think we need to, get into all the complexities of the tax ramifications of phantom stock, but I think, the one thing I think is important to mention from the employee standpoint, if he actually owned real equity, he could be looking at capital gains down the road potentially when the business gets sold. As just an owner of phantom rights, he's stuck with ordinary income while at least the business is stuck with the deduction. Is that correct?
That's right. That's probably the biggest downside to phantom stock, which is in most designs, the employee does not get the right to capital gains treatment because essentially they get taxed ordinary income, treated as wages when they either get paid the cash or when they receive the shares that are not subject to forfeiture.
Right. But on the flip side, at least the business owner then is getting an ordinary deduction for it, which is nice.
That's right.
Yeah.
Okay, so this time's flying by. Let's talk about when phantom equity is right for our business. Walter and I own a business. When is phantom stock going to be right? And maybe when is it going to be the better option over some of the other options?
Sure. Phantom stock is good for a company if for some reason or another you don't want to issue equity. And so what's that some reason or another? Let's say you're an S Corp and you want to keep shareholders under 100. Phantom stock is a good idea for you because you can give someone the exact same rights as an equity holder without actually issuing equity. Same concept if you're an owner of a business that wants to maintain a certain status, like a small business, minority-owned business, woman-owned business, service-disabled veteran-owned business, and you need to keep an ownership threshold above a certain percentage, phantom stock would also be a good idea for you. If you, as Walter mentioned earlier, don't want to give your employees minority voting rights, that's another reason to grant phantom stock. And lastly, if you don't want to pay or settle an award until a sale of the company, that desire alone will probably eliminate the tax benefits of stock options and restricted stock. Because if a person can't exercise and don't vest until the sale of the company, you're not going to get long-term capital gain treatment. So if that's your goal, it's better to avoid the difficulty of administering a stock option plan or a restricted stock plan and just have phantom stock, because that's the easiest way to administer an equity-based award in that situation.
Okay, that's
Thanks,
good.
Paolo. This has been very, very educational for us. And I think it's been a great program for our listeners, because hopefully it's something that, maybe they've just become aware of by watching the program. So it's fantastic.
Mm-hmm.
Really appreciate it. Thanks for joining us. So 2 questions as we wrap up. Number 1, anything you would like to promote today? And number 2, how could our listeners contact you?
Oh, sure. I'm a regular kind of blogger at Miles and Stockbridge's labor and employment blog. So if you want to, see anything I've written, and I've written about restricted stock, phantom stock in the past, feel free to visit the Miles and Stockbridge labor and employment blog. You can just Google that, Miles and Stockbridge labor and employment blog, and you should be able to find me there. If you have any questions about phantom stock or any other questions about equity compensation, equity-based compensation, feel free to give me a call at 410-385-3713.
Fantastic. Thank you very much.
Thanks, Paolo.
Thank you for having me.
And listeners, if you would like help in maximizing the value of your business or planning for your eventual exit, you can reach Pat at 301-859-0860. You can reach me at 301-951-9090. You can also access resources at exitreadiness.com, grfcpa.com, and nslp.com. As always, thanks for listening. And until next time on the Exit Readiness Podcast, this is Walter Dial and Pat Ennis signing off.